Welcome to the CLS Market Review for the second quarter of 2013. I'm Matt Harwell. It was another solid quarter for the U.S. stock market. The S&P 500, a benchmark mostly composed of U.S.-based large companies, was up 3%. The Russell 2000, a benchmark of smaller companies, was also up about 3%. The good news ends there, though, as balanced, diversified portfolios lagged. International stocks, for instance, lost 3%, with even worse losses posted for emerging market stocks. The bond market didn't provide any gains either, as the Barclays Aggregate Bond Index lost 2%. These quarterly numbers, however, hide how exceptional the first 6 months have been for the financial markets. For some of these highlights from the first 6 months of the year and how they are impacting CLS's thinking and portfolios, we go now to our Chief Investment Officer, Rusty Vanneman. Rusty?
Thanks, Matt. While this is a quarterly review, let's hit some of the interesting sound bites from the first 6 months. The S&P 500 index had its best first half of the year since 1998. The Russell 2000 had its best first 6 months of the year since 2003. Japan, in local currency terms, had its strongest first 6 months since 1972. Adjusting that back into U.S. dollar terms, gains were greatly reduced, but still their best since 1999. Emerging markets such as China did not fare as well. China, for instance, had its worst first-half return since 2008. Fixed income, as defined by the Barclays Aggregate Index, had its worst first half of a year since its notable bear market year back in 1994. By some measures, the gap between the return on stocks and the return on bonds was the worst since 1987. Lastly, commodities also suffered last quarter and half for the year. Gold, for example, had its worst first half since 1981. In sum, despite gains on the year, it was difficult for balanced portfolios to keep pace with the domestic stock market benchmarks, such as the S&P 500. What does this mean for the remainder of 2013? How does this impact the investment themes around which we've built our portfolios? The quick answer is that while we naturally remain bullish on balanced and diversified portfolios, our enthusiasm for many of the recently underperforming asset class segments has actually increased, giving them more attractive valuations. Let's review our outlook for both the stock and bond markets, and then revisit our investment themes for 2013. Stock market returns are driven by earnings growth and how much investors have to pay for them. Let's look at the key variables. First, the stock market continues to remain reasonably priced. Despite strong gains in recent years, it's still not too expensive. Here's an updated chart showing the earnings yield for the stock market and comparing it to its 20-year average. Though prices gained more ground in the second quarter, the earnings yield only dropped modestly and still remains well above its 20-year average of approximately 5%. The dividend yield story is similar. They too are above their 20-year average, suggesting that the market is not expensive. At least compared to its history, stocks remain on sale. Relative valuations also look attractive. Despite the gains in stocks and the losses in fixed income, stock valuations look appealing next to bonds. Or maybe just fixed income looks really unappealing. In short, an earnings yield of 6% remains attractive, especially compared to long-term bonds, including 10-year Treasury bonds that yield less than half of that. Things are a bit more mixed when looking at profit margins in addition to sales and earnings growth. Year-over-year revenue growth has fallen to 3%. This is positive, but below average and trending lower. Year-over-year earnings growth, meanwhile, has fallen to negative 2%. Earnings growth has been trending lower for nearly 2 years now, so obviously the stock market can perform well in this environment. Profit margins also remain well above long-term averages. That's a big reason why the stock market has done so well in recent years. However, like earnings and sales growth, profit margins have recently started to turn lower. The last 2 times profit margins started to contract after reaching elevated levels preceded the last 2 recessions. This is something that bears monitoring.
Turning now to our investment themes, we would like to introduce CLS analyst Kostya Edis to talk about our focus on high-quality stocks. Kostya?
Thanks, Matt. High-quality companies tend to be those with relatively higher profitability, stronger balance sheets, and higher stock dividend growth. They also have a tendency to be larger companies and are often considered growth stocks. There's an argument to consistently emphasize high-quality stocks as they have outperformed on a total return and risk-adjusted basis versus the overall market for essentially the last 25 years. In fact, global evidence for high quality is fairly compelling. Quality has outperformed both for large and small cap stocks for not only the global market but also consistently across all regions such as North America, Europe, Japan, and Asia. Tactically, though, the argument for quality is even more compelling. In an environment where economic growth is likely to be below average in the years ahead, and where interest rates are more likely to rise than fall, higher quality companies should outperform. For investors worried that the stock market has seen the bulk of its bull market gains, given its strong performance in recent years, it might be reassuring to know that not only do higher quality stocks have higher dividend growth, that should reduce overall price volatility, but they also tend to outperform after market peaks. High-quality stocks tend to be large-cap growth stocks, though it is not always the case as small companies or value stocks can be considered high quality. Currently, large-cap growth stocks appear to offer the best return potential of the style boxes, and at the lowest risk to boot. In addition, looking at beta, a measure of price volatility, over the last 5 years, large-cap growth stocks have tended to be the most stable, as they represent the only style box with a beta less than that of the overall market. For investors concerned about the economy's potential growth or the bull market's maturity, high-quality stocks are an excellent segment of the stock market to emphasize. CLS has been and will continue to do so for the foreseeable future.
Thank you, Kostya. Next up, we'd like to discuss our global focus. This theme has not helped our portfolios in the last 6 months, but given the underperformance of international markets this year, and over the last 5 years for that matter, valuations have become a lot more attractive. Here now to present some interesting valuation data with 2 key takeaways is CLS analyst Grant Engelbart. Grant.
Thanks, Matt. This chart shows valuations of various markets around the world. Essentially, a larger positive bar indicates better value. As you can see, most of the world looks cheaper than the US, especially emerging markets, Japan, and parts of Europe. Another theme that hasn't helped diversified portfolios this year is our basic necessities theme. Here, we look to build positions in commodities, commodity producers, or both. What has saved our bacon is that we have been reluctant to aggressively build positions until we start to get a bit more price confirmation. As shown earlier, there has been little price action this year to warrant aggressively building positions. Among the various reasons to own commodities, let's consider 2. First, commodities are typically the best asset class when inflation starts to rise from low levels. While inflation and inflation expectations are low and have fallen as of late, we think inflation could actually surprise in the months ahead. More on this later. And if it does, commodities should perform relatively well. Second, we believe emerging market demand should prop up commodity prices. Though global investors have apparently shifted global growth and inflation expectations lower earlier this year, the data doesn't necessarily confirm that emerging demand has significantly fallen. For example, in looking at petroleum demand, it doesn't appear that there has been much of a drop-off in demand at all.
Thank you, Grant. Our final theme is creative diversification, and this has helped CLS portfolios this year. Here now to discuss is, once again, Rusty Vanneman. Rusty.
Despite the recent backup in yields, by some measures the sharpest increase in Treasury yields on a ratio basis since the early 1960s, the bond market's long-term return potential remains below average. Real interest rates remain extremely low. When real rates, in other words, when one adjusts Treasury rates by inflation, when they're lower, if not negative, the typical return for bonds moving forward is below average, if not negative. Another issue is potential inflation, or at least inflation expectations. Though inflation is low and expectations have fallen this year, we think that there is a decent chance inflation could surprise to the upside. In short, given the surge in house prices of late, this suggests we'll likely see a big uptick in rents in the year ahead. As for how we position our fixed income holdings, the fact the typical CLS portfolio cut duration, in other words, its interest rate sensitivity, roughly in half before the sell-off, that has added value, or at least it limited losses. While our near-term outlook on interest rates isn't as negative as it was, we are definitely not bullish yet. As a result of this view, we are continuing to creatively diversify portfolios by using asset class segments and strategies other than investment-grade bonds. This includes alternatives, hybrids, and non-traditional fixed income securities.
That concludes our update for the second quarter of 2013. Our next quarterly market review will be in October. Also, check back with us each Tuesday for our weekly market review, through which we'll give timely updates on portfolio positioning and how we're specifically applying our investment themes. The weekly market review is available as a podcast subscription on iTunes as well, and in video format right here at clsinvest.com. From all of us here, I'm your host, Matt Harwell. Thanks for watching, and thank you very much for your time and trust in CLS Investments.